Okay, so let's just be real for a second. There is this pervasive myth in our culture,
Mhm.
and honestly, it's mostly fueled by movies and, those Twitter screenshots we all see.
Oh, yeah.
That successful trading is all about the big score. You know the vibe.
A Hollywood version of Wall Street, it's pure adrenaline.
Exactly. It's the guy who puts his life savings into one call option, sweats through his shirt for 6 hours, and then, wakes up and buys a Lamborghini.
Right. But
Wow.
if you're chasing that kind of adrenaline, you're not really trading. You're just gambling with better charts.
And the house is going to clean you out eventually.
It's a harsh reality check, but a necessary one. The document we're diving into today is titled Trading Small, Trading Consistent.
Okay.
It's an internal report from the Red Team trading community, written by an author named Dharma. It's dated just recently, February 2026.
And what's the big idea?
The central premise is it's insulting to the ego. If you want your bank account to be exciting, your daily routine has to be incredibly, almost painfully boring.
Boring is a hard sell. I mean, we all want the fireworks. But I read through this report, and what struck me is that it's not really a technical manual, is it?
Yeah, not at all.
It's not telling me which moving average to use or anything like that. It feels more like a psychological intervention.
That's the best way to describe it. Dharma is heavily, and I mean heavily, channeling the work of Mark Douglas.
The author of Trading in the Zone.
The Bible of trading psychology, yeah. So the mission of this deep dive is to solve a paradox that kills most traders. This belief that money management, the math, and risk management, the psychology, are two different things.
I've always thought of them separately. Money management is my spreadsheet. Risk management is my stress ball.
And this report says, no, they are the exact same thing. Your spreadsheet is your meditation. If you get the math right, the psychology, it just fixes itself.
Wow.
Every single position sizing rule, it argues, serves both functions at the same time.
Okay, there's a brilliant analogy about seatbelts coming up later that I really want to get to. It completely rewired my brain.
It's a good one.
But let's start with that core philosophy. Section 1 is called One Rule, Two Functions. Break that down for us.
So, okay, let's look at the standard advice everyone hears. Trade small. A trader hears that and thinks, okay, I need to size my position small so I don't lose all my cash.
Right.
That's the money management function. It preserves your financial capital, controls your drawdown. That's the obvious part.
The survival mechanism. Don't go broke so you can play tomorrow.
But the report argues there's a second, hidden function. When you size a position small, you're also preserving your emotional capital. You're basically tranquilizing your own anxiety before it even starts.
Emotional capital. I like that. It's the idea that you only have so much mental resilience in a day, right?
Precisely. If you burn all of it stressing over one oversized trade, you've got nothing left for the next decision. The example they use is the 5% rule. It's simple. You never allocate more than 5% of your total portfolio to a single position.
Okay, but I have to play devil's advocate for a minute.
Go for it.
Because I know what you're probably thinking. 5%. That feels, it feels incredibly conservative.
It does on the surface.
I mean, if I have a $10,000 account, we're talking about a $500 position.
Yeah.
If that stock pops 10%, which is a great move, I make what, $50?
$50, yep.
I'm not exactly quitting my day job to live on a yacht with $50.
And that right there, that's the trap. The report addresses this head on. If you're focused on the $50, you're outcome focused. You're trying to get rich today.
Okay.
But let's flip it. Look at the math on the downside. If that position tanks, let's say a bad earnings report drops at 20%, a total disaster scenario.
Yeah.
How much did your total account lose?
Let me see. 20% loss on a 5% position. That's a 1% hit to the total account.
1%. Now here's the million-dollar question. Can you sleep at night being down 1%?
Yeah, of course. I wouldn't even notice it. I'd sleep like a baby.
And that is the risk management function. Because the loss is too small to trigger your fight or flight response, you don't panic. You don't do that classic revenge trading thing.
Where you immediately double down because you're angry and you want to win it back.
Exactly. You stay rational. The report has this great quote. If you understand the why behind the rules, they stop feeling like constraints and start feeling like architecture.
Architecture. That's a key distinction. Architecture holds the building up. Constraints just get in your way. But to be okay with just making $50 on a great trade, you really have to shift your whole worldview. Which brings us to the Mark Douglas framework.
This is the heavy lifting. This is the real work. The report talks about shifting from thinking in certainty to thinking in probabilities.
Which just runs contrary to human nature. We're wired to want certainty.
Yeah.
We want to know why a stock moves or if it will go up. We want to be right.
But the market doesn't care if you're right. It's just a chaotic environment. Douglas's framework and the red team philosophy, it requires you to accept that you just can't control the market.
You can't.
You can control your entry, your sizing, and your exit, but you cannot control price.
So it's about shifting from being outcome-focused to process-focused. You're not judging yourself on, did I make money, but on, did I follow my rules?
Correct. It's the difference between a professional gambler and a tourist at the casino.
How so?
The casino doesn't care if it loses a single hand of blackjack. It doesn't get angry. It knows the probabilities are in its favor over 10,000 hands. They don't hope, they know.
So this report lists 5 fundamental truths that a trader needs to accept to basically become the casino.
Yeah, and they sound simple, but living them is really, really hard.
Okay, let's run through them.
All right. Truth number 1, anything can happen.
Which means even the most perfect A-plus setup, all the indicators aligned, can still fail because, I don't know, a CEO tweets something crazy.
Or a war starts. Exactly. There are variables you just cannot see. Truth number 2, every moment is unique.
Just because a chart pattern worked last week doesn't mean it's going to work today. The players are different.
The context is different. Yep. Truth number 3, you don't need to know what happens next to make money.
That's the one that trips people up. They think they have to be fortune tellers.
But you don't. You just need an edge, a statistical advantage that plays out over the long run. You don't need to know the outcome of this coin flip to know that heads comes up 50% of the time.
Which connects to number 4. There is a random distribution between wins and losses.
This is so vital. You could have a strategy that wins 70% of the time. That's a Hall of Fame strategy.
Absolutely.
But you could still lose 5 times in a row. That's just randomness. It's not the market targeting you. It's just how distribution works.
And finally, number 5. The edge is in the aggregate.
This is the big takeaway. No single trade matters. Your edge only appears when you look at a series of, say, 50 or 100 trades. Consistency over time. That's the only thing that counts.
So if I truly believe that no single trade matters, then betting half my account on one trade is. It's just logically inconsistent.
It's completely irrational. If the edge is in the aggregate, then betting the farm on one instance is just maximizing your risk of gambler's ruin.
Going bust before the probabilities can even work for you.
Exactly.
Okay, so that's the mindset. Think like a casino. Let's get into the nuts and bolts. The report gives specific practical rules. The how. We touched on the 5% rule, but there's a nuance there about the series effect.
Right. So rule 1 is the 5% position sizing rule. We mentioned the math. A 20% stock drop equals a 1% portfolio hit. But the report highlights that this lets you survive a drawdown series.
Meaning a string of losses.
This string of losses. If you trade this small, you can mathematically absorb 10, even 20 consecutive losers and still be in the game.
10 losers in a row. That sounds like a nightmare.
Emotionally, it's painful. Sure, nobody likes it. But financially, you're still alive. You have chips at the table.
And you can catch the winning streak that inevitably follows.
But if you bet big, say 25% of your account per trade, 3 or 4 losers in a row, and you are mathematically ruined, you're down 60, 70%.
And once you're down that much, you need like a 200% gain just to get back to even. It's the game over screen.
Exactly. So rule 1 is about staying in the game. Now, rule 2 is interesting because it deals with greed. The 15% profit protection rule.
This one stood out to me. What's the logic here?
This is all about protecting your headspace. The rule says, when your unrealized profit on a trade hits plus 15%, you must set a mechanism to protect at least half of that gain.
So if I buy a stock at 100 and it goes to 115, I have to lock some of that in.
You don't have to sell right there, no, but you need to move your stop loss up. You cannot let that winning trade turn into a losing trade. The report calls it psychological trauma. Watching a green trade turn red is devastating. It destroys your confidence.
Oh, it's the worst feeling.
It makes you hesitant on the next trade because you feel like you messed up and gave money back.
It's that feeling of having money in your hand and then just dropping it down a sewer. You beat yourself up about it for days.
You do. And if you're beating yourself up, you're not trading well. This leads to a crucial philosophy in the report about entries and exits. It says, entry is a choice. Exit is a condition.
That's a strong phrase.
Yeah.
What does that mean in practice?
It means you have free will before you enter the trade. You're objective, you're calm, but the moment you're in the trade,
I lose my objectivity. I become a fan of the stock. I'm rooting for it.
your brain chemistry literally changes. You've got cortisol and dopamine spiking. You start hoping and fearing. So your exit cannot be a decision you make in the moment. It has to be a predefined condition.
Like a specific price point or a trailing stop, something automated.
Or at least pre-decided. It cannot be based on emotion.
So if you find yourself staring at the screen, sweating, asking, should I sell now? You've already failed the system.
You've already lost. Regardless of whether you make money on that specific trade, you've broken the process. And eventually that will cost you everything.
I want to pivot to the part of the report that really stuck with me. The seatbelt analogy.
Ah.
It differentiates between compliance and acceptance. This felt very relatable.
It's a brilliant metaphor for risk psychology. Think about seatbelts in cars. There are 2 stages of wearing one. Stage 1 is before understanding. You wear it because the law says so, or your car makes that annoying beeping sound.
I remember being a teenager and hating it. It felt restrictive. I only wore it to avoid a ticket.
That is compliance. You're following the rule, but you resent it. A lot of traders are in this stage with risk management.
They size small because a book told them to.
Right, but deep down they're thinking, man, if I could just bet bigger, I'd be rich by now. They see the rule as an obstacle.
And the problem with compliance is that the moment you feel super sure about a trade.
You take the seatbelt off. You bet big. And that's usually when you crash.
So what's stage 2?
Stage 2 is after a crash. Or hopefully after deeply visualizing what a crash looks like. You wear the seatbelt automatically because you know viscerally that it's the only thing standing between you and, well, death.
It's not a rule anymore.
It's part of your identity. You feel naked without it.
It stops being a restriction and starts being a tool for survival?
Exactly. The goal of this report is to get us from compliance to acceptance without us having to blow up our accounts first. They want you to visualize the black swan event.
The event nobody sees coming.
Imagine a stock you own halts trading. News comes out, fraud, a lawsuit, a geopolitical disaster. The stock opens the next morning down 50%. This happens. It's rare, but it happens.
If I have half my account in that stock because I was sure about it, I just lost 25% of my net worth in a second. I'm out of the game.
Devastated. But if you followed the 5% rule, a 50% drop in that one position is a 2.5% hit to your total portfolio.
That's nothing. I mean, it's annoying, but it's a bad Tuesday, not bankruptcy. I can make that back in a couple of weeks.
Precisely. As the report says, trading small is not conservative. It is strategic. It builds a portfolio that is essentially bulletproof.
Okay, but let's go back to the growth argument. Because the biggest pushback is, I want to grow my account fast. The report actually breaks down the math of the tortoise versus the hare, and the results are really counterintuitive.
The math of compounding is where the magic happens, but it's so hard for our brains to grasp. The report compares scenario A, small, consistent gains. Let's say you aim for a 2% gain on your total account value 3 times a week.
2% doesn't sound like a Lamborghini. 2% is a nice dinner.
No, but do the math. 2% gain 3 times a week over a month, that compounds to roughly 26% growth per month.
Wait, 26% a month? That triples your account in a year.
More than triples. That's exponential growth.
Yeah.
Now compare that to scenario B, the big win trap. This is what most new traders chase. They bet huge. They score 30% win on their account in one day.
They feel like a genius. They're posting screenshots.
Of course. But because they're betting huge, they're exposed to massive volatility. So the next day or the next week, they take a 25% loss.
Okay, let's do the napkin math. Plus 30%, then minus 25%. In my head, I'm still up 5%, right?
Intuition says yes. Math says no. This is called volatility drag.
Volatility drag.
If you start with $100 and go up 30%, you have 130. If you then lose 25% of 130, that's a loss of $32.50.
So I'm left with $97.50.
Mm-hmm.
I'm down. I had a huge win and a slightly smaller loss, and I actually lost money.
You are down 2.5% net. Big sizing creates this asymmetry where losses hurt you mathematically more than gains help you. This is why boring consistency outperforms exciting volatility every single time.
That is a sobering realization. It proves our intuition about numbers is it's often flat out wrong.
It is, and that's why we need rules to protect us from our intuition.
The report ends with something called the perception test, a way to diagnose your own psychology. I think this is great for our listeners to try right now.
It asks you to check your gut reaction. For example, when you hear 5% position limit, Do you feel safety? Or do you feel a limit on your potential?
If I feel limited, it means I'm greedy. I'm focused on the what if I win.
Not the what if I lose. Exactly. Here's another one. If you trigger a stop loss, do you feel like you failed? Or do you feel like the system worked as designed?
If I feel like a failure, I've attached my ego to the trade. I want to be right more than I want to be profitable.
That's the core struggle. The goal, according to this report, is to reach a state where a stop loss feels just like a business expense, like a restaurant buying napkins.
You don't cry when you buy napkins.
No, you don't feel like a failure. It's just the cost of doing business. You need napkins to run a restaurant, and you need small losses to run a trading business.
So how do we operationalize this? The report offers a daily execution checklist.
It's a 60-second ritual. 7 questions to ask before you click buy, and the rule is strict. If the answer to any of them is no, you don't trade, you walk away.
Okay, let's run through them. Number 1, setup identified based on system.
This filters out FOMO, fear of missing out. If it's not in your playbook, don't touch it.
Number 2, sized at 5% or less.
Non-negotiable. That's your seatbelt.
Number 3, predefined exit condition ready.
Do you know where you're getting out before you get in? If you haven't set the stop loss order, you're not ready.
Number 4, prepared to accept the loss.
This is the emotional check. Can you lose this money without losing your cool? If not, the position is too big.
Number 5, trading a setup or just need to trade.
Are you bored? Are you seeking dopamine? The market is not an entertainment center. It's cheaper to go to the movies.
Number 6, checked existing positions for 15% profit protection.
Manage what you have before you add more risk.
And finally, number 7, emotional state clean.
Are you still angry about yesterday's loss? Are you euphoric about yesterday's win? Both are dangerous. You need to be at baseline.
And if you can honestly answer yes to all 7.
You're trading with an edge. If not, sitting on your hands is actually a profitable decision.
It's amazing how much not trading is actually a huge part of successful trading.
The market will always be there tomorrow. You don't have to be in it every second.
This deep dive has really highlighted how much of this is internal. We spend so much time looking at charts and news, but the market is just a mirror reflecting our own psychology back at us.
That's the core message. The market isn't a threat. It's just neutral information. The threat is inside us. Our fear, our greed, our lack of discipline. This report just gives us the structural tools to survive ourselves.
The market teaches through pain. That's a rough lesson, but it seems to be the only way most people learn.
It is. But as Dharma points out, you have the option to learn through understanding instead. You don't have to crash the car to learn to wear the seatbelt. You can just look at the math we discussed and decide to be smart.
I think the final quote from the report sums it up perfectly. Calm is non-negotiable. Action is situational. Sizing is survival.
Powerful words. If you get the sizing right, you survive long enough to get the calm. And once you have the calm, the action becomes easy.
So here's a question for you to mull over as you go about your day. Are you wearing your risk seatbelt because you feel like you have to, or because you truly understand what the crash looks like? And more importantly, are you trying to be the gambler chasing the high, or are you trying to be the casino banking the edge?
If it feels like a chore, check your math again.
Thanks for listening to The Deep Dive. We'll see you on the next one. Stay consistent out there.
Take care.